studying your last two. I swim with tea when they turned in. The staring down to mute and can lend a pole that some kid died.
When the passive income grind rules were introduced, tax professionals across Canada faced a new challenge. For many years, owner-managed corporations had accumulated investment portfolios inside their corporate structures. Then, almost overnight, the tax landscape changed. The introduction of the passive income grind meant that investment income could now directly reduce access to the small business deduction. As a result, accountants, tax advisors, tax lawyers, and financial planners began asking a new question: how should clients respond? Across Canada, from Vancouver to Halifax, practitioners started reviewing corporate structures, investment portfolios, and long-term tax plans. Business owners wanted answers. Would these new rules increase their taxes? Should they change their investments? Should they reorganize their corporations? Or should they simply accept the new rules and move forward? The reality was that there was no universal solution. Every corporation was different. Some businesses held large investment portfolios. Others needed retained earnings to fund future expansion. Some owners planned to retire soon. Others expected to operate their businesses for decades. Because of these differences, tax advisors could no longer rely on a single planning strategy. Instead, they had to analyze each client's unique circumstances. This often involved reviewing corporate tax returns, examining investment income sources, evaluating holding company structures, and discussing the owner's personal and business objectives. What made the situation even more challenging was that solving one tax problem could easily create another. A strategy that reduced passive income might trigger personal taxes. A restructuring that improved one area could increase complexity somewhere else. As a result, practitioners began approaching the passive income grind much more strategically. Rather than looking for a quick fix, they focused on finding the best overall outcome for each client. And that's the key message of this section. The passive income grind did not create a single planning solution. It created a planning process, a process that requires advisors to evaluate multiple options, weigh the benefits and costs of each strategy, and select the approach that best fits the client's goals. In the next slide, we'll explore the 4 most common strategies that practitioners began using in response to these new rules. Once tax advisors understood the impact of the passive income grind, the next challenge was deciding how to respond. Across Canada, practitioners generally began evaluating 4 broad planning strategies. Let's look at each one. The first strategy is extracting surplus cash from the corporation. The idea is simple. If excess corporate funds are generating passive investment income, one option is to remove some of that cash from the corporation through dividends, bonuses, or other planning techniques. By reducing the amount of capital available for investment inside the corporation, future passive income may also be reduced. However, this strategy often creates another issue. Money that leaves the corporation may become subject to personal tax. So advisors must carefully compare the corporate and personal tax consequences before recommending this approach. The second strategy is corporate restructuring. Some businesses review their ownership structure, holding companies, and investment arrangements to determine whether changes can improve overall tax efficiency. In some situations, restructuring can help manage passive income exposure or better align the corporate structure with the owner's long-term objectives. But restructuring can also introduce legal costs, administrative complexity, and unintended tax consequences. As a result, these changes require careful analysis. The third strategy involves changing the investment strategy itself. instead of focusing on investments that generate significant annual income, such as interest-bearing assets. Some corporations may shift toward investments that emphasize long-term growth. The objective is not necessarily to reduce investment returns. Rather, it is to reduce the amount of passive income reported each year, and therefore reduce pressure on the small business deduction. Of course, investment decisions should never be made solely for tax reasons. The investment strategy must still align with the corporation's risk tolerance and financial objectives. The fourth strategy may sound surprising: do nothing. In some situations, the passive income grind may simply be accepted. Why? Because every planning strategy has a cost. There may be personal taxes, legal fees, restructuring costs, administrative burdens, or investment trade-offs. If those costs exceed the tax savings generated by the planning, then accepting the grind may actually be the most sensible option. And this brings us to the most important lesson of the slide. There is no perfect solution. Every strategy involves benefits, costs, risks, and trade-offs. The best choice depends on the client's specific facts, future plans, investment goals, and overall tax situation. That is why professional tax planning is rarely about finding a single answer. Instead, it is about comparing alternatives and selecting the option that produces the best overall result. In the next slide, we'll explore the mindset that experienced tax advisors use when evaluating these decisions, and why the best strategy can be completely different from one client to another. After reviewing the various planning options, it's tempting to ask a simple question: which strategy is the best one? But experienced tax advisors know that this is actually the wrong question. The better question is, which strategy is best for this particular client? And that's the real purpose of professional tax planning. When a client has significant passive investment income, there is rarely a single correct answer. Instead, there are multiple possible paths, each with its own advantages, disadvantages, costs, and risks. For example, consider a professional corporation with a large investment portfolio. That client may benefit from extracting surplus cash, restructuring part of the corporate group, or changing the investment strategy. Now compare that to a manufacturing company. This business may need substantial retained earnings to finance future growth, purchase equipment, or fund expansion. For that client, preserving capital inside the corporation could be more important than completely eliminating the passive income grind. And consider a retired business owner. Their priorities may be completely different again. Rather than focusing on future business growth, they may be more concerned with retirement income, estate planning, and extracting corporate assets efficiently. Each client has different objectives, and because the objectives are different, the optimal strategy may also be different. This is why tax planning is not simply a calculation exercise. It is a decision-making process. A good advisor evaluates multiple factors before making a recommendation. How much passive income is currently being generated? Will the corporation need funds for future growth? What personal taxes might be triggered if money is extracted? Could a restructuring create capital gains or other tax consequences? And perhaps most importantly, what are the owner's long-term business and personal goals? Only after considering all of these factors can a meaningful recommendation be made. And this leads to the most important lesson of the entire section. Good tax planning is not about avoiding the passive income grind at all costs. In fact, there are situations where accepting the grind may be the most sensible decision. The real objective is to choose the option that produces the best overall outcome after considering all tax consequences, business needs, investment objectives, and long-term goals. That is what separates strategic tax planning from simple tax minimization. A great tax advisor doesn't just reduce taxes. A great tax advisor helps clients make better decisions. And that's exactly how practitioners across Canada approach the passive income grind today.